Hi, welcome back. I'm Naren, and today we will discuss about tax filing on capital gains in case of mutual funds and stocks. And this is specific to resident individual. So, so we will be covering the capital gains only for mutual funds and stocks, and the gain is the difference between the sale price and the acquisition price when the sale price is more than the acquisition price. And there is something called grandfathering rule in case of capital gains. And this is related to the Finance Act 2018. And before this act, the long-term capital gains on mutual funds and stocks was exempt, so that is zero tax. And after this financial act, they introduced 10% tax on the long-term capital gains. So the effective date was 31st Jan 2018. So if you have stocks or mutual fund bought before 31st Jan 2018, then the acquisition price is considered to be the maximum of the buy value and the value on 31st Jan 2018. So that means if in case the value of your units increased uh, from the date of purchase to 31st Jan 2018, then the tax on that increase is nil. So the value as on 31st Jan 2018 is considered as the acquisition price. And how can you get this data of the value as on 31st Jan 2018? You can get the capital gain statement from the fund house website, your broker. So what are the tax rates? So there are different tax rates for the equity versus debt. So for equity, if it is the stocks or the equity mutual fund, and the debt is for the bonds or the debt mutual fund. So a mutual fund with more than 65% portfolio in equity is considered as equity mutual fund. And to know whether your mutual fund is an equity or the debt, you can check the portfolio of that mutual fund from your fund house website. For equity, the tax rates for long term is 10%, and long term is uh, considered as more than 1 year. So if you hold your stocks or the equity mutual fund units for more than 1 year, so that is considered as a long term and 10% tax is applied. And note that for long term equity, till 1 lakh there is no tax. So only if your long term capital gains crosses 1 lakh in a financial year, only for that extra amount, a tax of 10% is applied. And note that for mutual funds, if you have a SIP, then the each unit is considered as a separate entity, so that its purchase time and sale time is considered to bucket it either in long term or the short term. Suppose if you have a loss in your long term equity or the mutual fund sale, then you need to set off that loss only against the long term capital gain, not against the short term gain. If suppose there is nothing to set off in a financial year, you can carry forward for max 8 years. For short term, if it is less than or equal to 1 year, it is considered as short term. And the tax rate is 15% for short term capital gain with STT. So regular equity traded in the stock exchanges and the equity mutual fund comes under with STT. For any without STT, it comes under your regular slab. For debt, The long term is more than 3 years, and less than that is short term. For long term, the tax rate is 20% with indexation, and for short term, it comes under a slab. And tax filing for the equity. For the short term, you can use the short-term capital gains in Schedule CG, that is capital gains, and under section 3.2. So you need to have your total value of consideration, which is the total sale value, and the cost of acquisition, which is the sales minus the units. And for long term, you need to fill out the Schedule 112A first, because that will auto-populate the Schedule CG while filing the tax. And about filing the tax for equity, for those units that you have bought after 31st Jan 2018, you can combine all the units into a single record with ISN code as IN not required and unit name as consolidated. You can have the full value of consideration as the sale price of all the units combined, and the cost of acquisition as the combined value, and the balance. And for units that you have bought before 31st Jan 2018, you need to have one record combining all the units per fund. So you cannot club more than one fund. And also under each fund, you can club all the records with the same sale price. So with the corresponding ISN code, unit name, number of units, and the sale price per unit, and the cost of acquisition of the original, that is before 31st Jan. And FMV per unit, the fair market value per unit, and the total of all the units that you are combining as on 31st Jan 2018. And the cost of acquisition without indexation, which is the maximum of the FMV total or the original. And the full value of consideration, that is the total sale price, and the effective balance. In case of debt, you can file the long-term capital gains in Schedule CG under from sale of bonds or debenture. It will go into section B2 of CG. For short-term capital gains, you can use from sale of assets other than A1, A2, A3, A4 section, which will end up at section A5 of CG. Hope this is helpful. If you find this useful, please like, subscribe and share, and thank you for watching.